The contents. We will learn 5 things today. Why invest in the Indian stock market, how to invest in the stock market correctly. The third one is how to trade using the DMAT account. We will also teach you everything you need to know about a DMAT account as well. The fourth thing is why the stock prices move. And fifth is how to pick the correct stock. India is a developing country and is a paradise for foreign investors and institutions. Countries like China, United States of America, and United Kingdom are all developed countries. But there is a drawback. The companies that operate in these countries are matured to its full potential. What that basically means is that they have grown so much over the years that there is only a tiny room for further growth. Whereas in India, due to cheap labor, high exports, good GDP, and unlimited resources with high consumption, it becomes, or rather is, the world's best investment hub. During the 2008 recession, the world was suffering as its financial markets collapsed. India, on the other hand, was as steady as a rock. Investors all over the world have so much faith in the Indian government, especially the Modi government, that more than $3 billion of funds inflow came in the Indian economy in the last 24 months alone. Indians steal jobs from the foreign countries, leaving the foreigners jobless. But what we don't know is that the foreign countries invest in our stock market, making 3 times more the money, thereby robbing us of our own wealth. Let me give you a simple example. An investment of 1 lakh in 2006 would give you 250 shares of Eicher Motors, each share costing 400 rupees approximately. Today, in 2016, your investment's worth would be 57.2 lakhs, each share costing 23,000 each approximately. So you see the potential of the Indian economy and the growth of the Indian economy. Eicher Motors is basically a truck manufacturing company, but it also owns the Royal Enfield brand. There are many other examples, but this is one of the most prominent examples which I like to share. Let's talk about India's favorite form of investment, the bank fixed deposit. And let me tell you how bad it is as an investment for an individual in India. Let's say you made an investment of 10 lakhs and the bank will give you an interest rate of 7.5% per annum. So 12 months later, your investment's value would be 10 lakh 75,000. See, what you don't know is that your profit is not exactly 75,000. There are certain taxes which are applicable on the profit. The first one is TDS of 10%, which comes out to be 7,500. The second one would be the income tax slab. Let's assume you fall in the second income tax slab, which is of 20%. So a deduction of 13,500 again. So overall, if you see, your total gain is only 54,000 on an investment of 10 lakh for 12 months. Right? Now let me talk to you about inflation. Since you made a profit of only 7,500, just a second, your total gain is only 5.4% per annum. The Indian inflation rate as of 2006 July is 6.31%. So overall, you're making a total capital loss of 1%, which is extremely bad. Let me give you an example which will help you understand what a capital loss is. Let's say you buy 10 kg bag of potato today for 100 rupees. So 12 months later, due to inflation, your amount would end up being 106.3 rupees. Now, let's say on the same date when you bought the bag of potato, you made a fixed deposit of 100 rupees, assuming that next year you might have a higher purchasing power. But what happened is, due to the interest rate of 7.5% and all the tax deductions, you only end up with 105.4 rupees. So overall, next year, you need to pay 1 rupees additionally to buy the same bag of potato you bought uh, like today, because of the inflation rate. So basically, this is called the corrosion of capital, which is extremely bad form of investment. And since most of the investors in India, like, or rather, people in India are not aware of this factor, they're losing their money. They're not gaining their capital, rather losing the capital and corroding their capital. Now let me talk to you about Nifty. Indian Nifty has a benchmark return of 10.8% for 12 months. Now, let me give you a situation. Let's say an investment of 10 lakhs today in the market. If you withdraw the fund maybe within 12 months, you are entitled to pay only 15% tax on the profit. Whereas if the investment in the stock is above 12 months, it is absolutely tax free. The example here is, let's say you bought 100 shares at 300 rupees each and sold the shares at 330 rupees each next year after 12 months. So if you sold these shares after 12 months, you are entitled to the total profit without any certain deductions. But let's say you sold the stocks before the 12 months, you need to pay a tax of 15% of the profit, which is 2550, which is not bad. You're not losing your capital, you're making a high return on your capital, right? Now, let me talk to you about how the structure of investment cycle works. The first one is an investor, which basically means me and you. We need to deposit our funds in the bank. Now, from the bank, we need to transfer our funds to the DMAT account or the stockbroker. Now, I would suggest you to have a talk with your bank, because they usually have a DMAT account present with their banking system. So you can open a DMAT account with them. Just call them up. They will tell you how to open the DMAT account. So once you open a DMAT account, basically you need to transfer your funds from the bank to the DMAT account or the stockbroker's account. Now, once the amount is transferred to the DMAT account, you can purchase the stocks or the company's shares from the DMAT account, your preferred shares which you want to purchase. The DMAT account. Now, there are certain DMAT accounts, like I told you earlier. The first one would be Axis Securities, which is linked with Axis Bank. Then there is Yes Invest, which is linked with Yes Bank. Third one, again, ICICI Direct, HDFC Securities, Karvi Broker, Motilal Oswal, and Zerodha. These are the three brokerages which are stock brokers. They do not have bank links, but you can open an account with them. They will give you a demo on how to purchase the stock, how to transact the stocks and all. And this will again help you to navigate through the sections so that you can buy or sell the desired stocks. So the structure of the DMAT account. The first thing is open a bank DMAT account, then log into the DMAT account page, transfer the funds into the DMAT account, and then purchase your desired stocks like we spoke earlier. Situation is like this. Assuming that you choose to buy Maruti Suzuki Limited, assuming one share cost 4,900, and assuming you want to purchase 10 such stocks, so you need to transfer 49,000 from your bank account into the DMAT account. Now, once you transfer that, then you can simply go to the buy and sell section in the DMAT account page and place an order for a buy order, which will help you to buy the share. You can call the helpline support or the help desk if you find it difficult to do it on your own. Now let's talk about company shares and stocks. There are two types of exchanges in which we can trade in the Indian stock market. The first one is the National Stock Exchange, which I would like to talk to you about, and the second one is the Bombay Stock Exchange. Now, I would recommend you to trade in the National Stock Exchange for the starting point, because it's uh, a bit like safer, because you see there are 5,000 plus listings in the National Stock Exchange, because they have a higher criteria which the companies need to fulfill in order for them to be listed in the National Stock Exchange. Whereas the Bombay Stock Exchange has more than 7,000 listings, is because they have a smaller parameter which companies need to succeed or satisfy in order for them to be listed in the stock market or the secondary market. So try trading in the National Stock Exchange or the NSE for the beginners. Okay. Let me talk to you about the stock market prices and how they move. Consider the basic case of demand and supply. If there's more demand, i.e., more buyers, the stock prices will go up. And if there's more supply, i.e., more sellers, the stock prices will go down. The price of the stock we see on the TV screen flashing and on the mobile app is basically the market value of the stock. The market value of the stock basically means the value of the stock considering its assets, like its operating cash balance, building it owns at its present value, plant its own and its production capacity, etc. And on the other hand, liabilities like loans which the company needs to pay back, the interest it needs to pay off, etc. If you notice, I'm talking about the figurative speeches here, figurative figures here actually. We do not consider the value of building it purchased at or the cost of acquiring the plant 20 years ago. We talk about the intrinsic value of the company. Big financial institutions calculate the fair value of these assets and liabilities to determine the market price or the intrinsic value of the company. Hence, the price at which the assets were acquired are irrelevant to the market price calculations. The prices go up and down based on the assumptions that the company's performance and the profit and loss it can make over the time. You as an investor need to keep in mind whether the company is able to make profits in the long run and won't collapse in case of a short-term problem. Let me give you an example. Let's say Maruti Suzuki plans to launch a new car this month. That basically means more sales for the company, which would boost up the revenue and profits. Hence, the prices will go up because investors think it will do well to launch the car, and they will start buying the shares of the company. The second example would be Larsen and Toubro. The infrastructure giant lost a big deal to build a bridge. Let's assume that. This will cause the company's stock prices to go down because investors will feel it lost the project, hence the less revenue for the company, and then investors would start to sell their stock holdings. How to find the ideal stock to invest? Use your gut feeling. Invest in the company you have always heard about, from people in general, from news or some company whose product you use and have full faith in the company's survival. Google search the stock and read the news section. Invest if you feel the company is on the right track. Follow the news channel. The business news channel will keep showing you good stock picks, and every now and then you can choose the best one you like out of the list. Try installing the Money Control app on your mobile phone. It's available on Android and iOS as well. So you can just go to moneycontrol.com, click on the link. It will show you the app installation pages from where you can navigate to the installation of the application. Now, moneycontrol.com is a stock news and activities website. Keep a track of the activities in the website and install the mobile app, like I told you earlier, which will help you to keep a track of the movement of the stock which you are interested in. Use technical analysis. Technical analysis is a widely used stock movement study. Stock traders use this technique to determine the stock movement, i.e., the change of the price, whether it go up or will go down, is calculated using the study of charts with indicators like momentum, the force of the investors, whether they are buying the shares or selling the shares, and so on and so forth. The fifth one is the fundamental analysis. Both long-term investors and short-term traders use this technique to determine the price movement using companies' financials like the book value, the price to earning ratio, etc. Like what this basically does is it calculates whether the company is going to make profits in the long run, uh, assuming their cash flows, the structures of their asset holdings, and so on and so forth. Right. The sixth one is subscribe to my channel. Very soon I will be doing a series of video in which I would put forward my opinion on the stock recommendations given by big stock analysts. Let me give you a warning. Recommendations given by analysts is not foolproof. So invest wisely. What I do is I study the charts and fundamentals to determine if the stock pick given by the pros are a genuine tip or not. Okay, so thank you for watching this video. Hope you enjoyed.